Welcome back to my 10 favorite people. Hope you're doing well. I'm incredibly excited for today's video because Bitcoin held our major support level at 109,000 and our macro structure remains fully intact. Believe it or not, since we last spoke this weekend, Bitcoin dropped a little bit over 3% and somehow we saw another roughly $1 billion in liquidations. And this is why I never recommend leverage trading on this channel. It's so much easier to zoom out and focus on the larger time frames and the major support and resistance levels so you're not flipping between bullish and bearish on every 1% move and getting liquidated and losing capital over and over and over again. I like to keep it very simple. If Bitcoin is holding above 109,000, bullish structure is still intact. And as long as Bitcoin is holding the 50-week moving average, our bull market is still underway until one of those two things changes. My bias is that Bitcoin still has higher to go. And this is what I wrote about in Monday's free weekly report called Holding the Line. As long as we stay above that previous range high, my base case is that Bitcoin still has higher to go. And I believe there are three main scenarios we have to watch out for: a bounce off support that results in new highs and price discovery, which is my base case with about a 60% likelihood as of right now. And then we have the scenario where we do bounce off support, but only make a lower high before new lows and testing the 50-week moving average. This would be our full reset scenario. I would perhaps put a 30% likelihood on that one. And then we have to face the fact that there is always a chance the cycle could be over and Bitcoin just falls through all these support levels, or we end up having a black swan event we didn't see coming. But I would only put that at a 10% likelihood. And I believe the best way to navigate markets is to have multiple scenarios you're watching out for, but then you change your portfolio based on what you think is most likely and least likely. And this is why my portfolio is set up the way it is. I'm convinced this is the most optimal portfolio that one can have because it makes just about everyone upset. People get mad at the cash position being 30% because it's a melting ice cube and it's losing money to debasement. And if you're not 100% Bitcoin, you're falling behind. And then you have a bunch of people upset about the Bitcoin position because Bitcoin is already above 100,000 and the upside is limited, and it doesn't make sense to hold Bitcoin when everybody is piling into Ethereum because Ethereum has way more upside and alt season's around the corner and Bitcoin's dead. And then you have the Bitcoin maximalists that are upset about my altcoin position because all altcoins are trash and Bitcoin is king. And if you hold any altcoins, you're just going to lose money, even though Ethereum and Solana have done so well this cycle. And I think they're going to continue to outperform Bitcoin between now and when the cycle ends. And I do think this portfolio prepares me for all possible outcomes. And I did take some profits on my Ethereum holdings this week and rotated them into Bitcoin because my Bitcoin holdings were getting quite small compared to my Ethereum holdings with the incredible move we've seen from Ethereum recently. And I know that might sound crazy because everybody is in love with Ethereum right now, and I do expect Ethereum to outperform Bitcoin for the remainder of the cycle, but Ethereum does also have more downside risk, so I don't want Ethereum to become too big of a portion of my portfolio, and I feel more comfortable having Bitcoin being my biggest holding. And as always, if you'd like to learn more about my portfolio automation system or mental models I use to navigate this market or common mistakes I see so many investors making, especially at this phase in the cycle, you can check out the Crypto Enjoyers program and community in the video description. But for now, in terms of answering how low Bitcoin will go, I do believe it'll hold this support level because of the previous swing high and the 20-week moving average, but it's possible that we come down and retest that 50-week somewhere around 100K. That would just complicate things quite a bit because it would be a false breakout above 110,000. And usually false breakouts result in pretty large corrections, and it's usually not a great sign for what's to come, but we'll adjust to that as needed once price action tells us to be concerned about it. And speaking of being concerned about it, let's talk about the Bitcoin cycle top and why most investors will likely be wrong about timing it. I know this CoinGlass 30 bull market peak indicators is incredibly popular and I get questions about it all the time, but I do believe it's going to get investors wrecked this cycle because it doesn't do a great job of accounting for diminishing returns, and I'm going to go over exactly why. Let's start with a fan favorite that I see commented all the time, the Pi cycle top indicator, which is calling for a Bitcoin price this cycle above 187,000. But what most people don't notice is that although this indicator has not failed in any Bitcoin cycle, the diminishing returns have been making it harder and harder to use. And in case you aren't familiar with this indicator, the Pi cycle top indicator flashes a sell signal when the 111-day moving average gets above 2 times the 350-day moving average. If we take a look at 2011, we can see that the green moving average spent quite a bit of time above the blue, giving investors a pretty prolonged sell signal. In 2013, with the double bubble, we had 2 crosses, but they were quite a bit shallower than the cross we saw in 2011. In 2017, the green moving average barely crossed above the blue, and then in 2021, the moving averages barely touched. So based on that diminishing returns trend of the crosses getting smaller and smaller, and 2021 being a very, very brief touch, you would imagine that because of diminishing returns, they would not cross this cycle. And I know a lot of people say diminishing returns don't matter anymore because of institutions and bigger players, but Bitcoin's market cap is also a lot bigger. So the laws of markets don't change. You just have bigger players moving a bigger market cap. So you still end up with diminishing returns, even if the main players have changed. Let's take a look at another quick example, the 2-year MA multiplier, or the Mayer multiple, calling for a Bitcoin top above 350,000 this cycle. But what do you know? The sell signals have been getting smaller and smaller. The sell signal for this one is price going higher than 5 times the 2-year moving average. And notice how the time spent above that red line has been less and less. It couldn't even get above it in the last cycle, because as an asset gets bigger and less volatile, it becomes harder and harder to get very extended away from moving averages because the returns get smaller and smaller and diminish over time. So I don't believe we're going to cross the red this cycle, and I don't believe Bitcoin is going to trade above 350,000, even though a bunch of people are going to be waiting for these peak indicators to flash a sell signal. And real quick, a lot of people talk about the Powell multiple. This looks at miner revenue divided by the 360-day average of miner revenue. And as you can see, lower high, lower high, lower high, lower high, lower high. I don't think this one is going to be able to reach levels it reached previously because miner revenues are getting squeezed. Same thing with the MVRV, probably the most popular on-chain indicator for Bitcoin. This looks at the market value divided by the realized value, or the market cap divided by the realized cap. You can see it's lower high, lower high, lower high, lower high, and diminishing returns make it very hard to use these indicators unless you actually take diminishing returns into account. So for example, in the previous cycle, it reached a reading of almost 8, and before that it was almost 12. So maybe this cycle you get close to 4 or slightly above it as a top for the MVRV Z-score. So most investors, especially retail investors, are going to be waiting for the red box up here because they're being told this time is different, so diminishing returns don't matter because institutions play by different rules, and it's likely going to play out the same way once again with diminishing returns. And this is why I prefer to use data points that work across asset classes and aren't as impacted by diminishing returns, like market sentiment with the fear and greed index, and seeing whether we're in extreme greed or normal greed or neutral or fear or extreme fear, or taking a look at seasonality, not because it has to repeat, but just to give us an idea of what has happened in the past. And it's also why I love looking at macro indicators like the global liquidity index that exist outside of Bitcoin and seem to be one of the main drivers of risk assets, especially Bitcoin, which doesn't have things like earnings driving it. So we'll see what happens, but for now, it looks like Bitcoin is putting in another false breakdown that have resulted in some pretty solid rallies recently. We have Metaplanet announcing they're going to be buying more Bitcoin. Strategy is also buying more Bitcoin, even though the purchases are starting to get smaller because Saylor is facing a lot of pressure for MSTR's underperformance over the past few months, as he's been using the premium to buy Bitcoin, which is upsetting shareholders. And we finally saw some spot ETF inflows once again after a 6-day outflow streak, but these Bitcoin ETF inflows are still pretty lackluster. You can see that August and July have been pretty lackluster in terms of Bitcoin spot ETF inflows, and that's almost entirely because all of that capital is chasing Ethereum instead. And this is usually what results in a cycle top for Bitcoin, Bitcoin dominates the narrative. Bitcoin dominates all of the money flow, like what we saw in 2021. But then eventually Bitcoin gets high enough that everybody starts rotating into and chasing altcoins. And people said this cycle would be different because institutions only want Bitcoin, corporate treasuries only want Bitcoin. But what do you know? The main thing that institutions, treasuries, whales, and investors care about alike is profits and number go up. So as soon as Ethereum got a narrative, and as soon as Ethereum got their own Michael Saylor, who keeps bull posting on Twitter and talking about it on CNBC, now Ethereum puts in its incredible rally as investors go further out on the risk curve from Bitcoin, and Bitcoin ends up flatlining and languishing a bit here. And usually the cycle tops once the experiment is done on Ethereum and all of these corporate treasuries start chasing assets even further out on the risk curve, causing Bitcoin and Ethereum to top and ending the cycle. But for now, things still look pretty solid for Ethereum. Bitmine is still buying a ton of ETH. SharpLink is also buying a ton of ETH, and we see these strategic reserves accumulating more and more of the supply alongside the ETFs as the ETFs try to front run the treasuries, and a bunch of normal investors and smart money are trying to front run those ETF inflows. So as long as we see these big inflows coming into Ethereum and as long as it keeps dominating the narrative, I believe it's going to go higher until eventually perhaps that attention moves on to something else like Solana. I do believe it's possible for us to see a 6,000 to 7,000 Ethereum, but I still am not in the camp that Ethereum is going to get anywhere near 20,000 because like we talked about earlier in this video, diminishing returns are a thing. Right now, we are in the belief phase of the long-term holder net unrealized profit and loss. This just measures how much unrealized profits long-term holders are sitting on. Once we're in the blue region, that means they're sitting on a ton of unrealized profits, hence euphoria. And usually once we enter that region, we're very near a top. We're still in the green region for now, but we will be entering the blue region very soon. Similar story from the MVRV and similar to Bitcoin, you see a very high reading in the 2017 cycle because the multiples were insane. Lower high in the 2021 cycle because the asset was bigger and diminishing returns took effect. So I expect to see diminishing returns here once again now that Ethereum has a market cap of nearly $500 billion. We also have Ethereum Bitcoin sitting at a resistance level here, which also made it easier to rotate some of my Ethereum into Bitcoin. Ethereum is up, I believe, around 140% against Bitcoin just over the past few months. And I'll rotate even more Ethereum to Bitcoin if we get up to that 0.5 Fibonacci retracement and 2022 low, because I do expect a lot of profit taking on Ethereum at that level. But I'm more than happy to take things week by week and see what the price action and market data tells us. But we are entering a difficult seasonality period for Ethereum, which is September. Every single time Ethereum has had an incredible August, we've had a red September. That doesn't mean this has to happen again, but mean reversion is a thing and profit taking is likely going to happen sometime soon. So we'll continue to monitor that as we get closer. But this gave me even more peace of mind and conviction rotating just some of those Ethereum profits back into Bitcoin after the recent outperformance. And speaking of recent outperformance, it is great to see Solana waking up a little bit. It seems like more and more people are waking up to what I've been talking about and what I said in the past video about Solana being the best risk-adjusted returns after Bitcoin and Ethereum, much better than XRP, much better than Cardano, and better than just about every other asset of that size. And for a couple of reasons, there's really three main catalysts for Solana that I think make it special. For one, the network usage is insane. You can say that it's mostly bots. You can say that it's mostly not real transactions. But if that's true, why aren't these other teams doing the same thing so their metrics can look better? Why is Solana higher than everything else by multiple orders of magnitude? And anybody who says Solana isn't the best user experience in this asset class clearly hasn't used any blockchain ever, because anytime I have to send stablecoins or do anything on chain, it is 10 times easier to do on Solana. The only thing that comes close is Base, which is a layer 2 on Ethereum. And I do believe it's good to have two separate approaches. You have Ethereum with the decentralized layer 2 approach. You have Solana with the slightly more centralized layer 1 high throughput blockchain. And I think it's going to be very hard for any other chain to outcompete one of those two in their current methodologies. I do believe the window for becoming the Ethereum killer for other chains is closing, and Solana is now the clear number two after Ethereum. And I believe institutional investors realize this. They're already setting up corporate treasuries to run the playbook that we saw on Bitcoin and Ethereum again on Solana. The reason why I don't think it's going to happen for something like BNB or Tron, even though those chains get a lot of usage, is because they're not going to get the same US institution inflows that Ethereum, Bitcoin, and Solana could, because Solana is a bit more US based. It's going to be easier for these corporate treasuries to buy Solana just because we're going to get those Solana ETFs by October. So it makes a lot of sense to me that after the Ethereum treasury playbook begins to slow down and the diminishing returns start to take effect, investors start rotating into Solana as the next one that's going to have that move. We see Sharps Technology announcing they're going to buy $400 million of Solana as well. And it seems like the main narrative for alt season this cycle is crypto ETFs and crypto treasuries. So I don't know how that's going to make the whole market go up like alt seasons in the past. Maybe some other narrative is going to pop up. But as of right now, really the only way these projects are getting attention is if they have a lot of corporate treasuries buying them, or if they have ETFs coming later this year. So I do think things like Cardano and XRP can do well because of that ETF narrative. But I do believe assets like Ethereum and Solana separate themselves a little bit because they are the ones with the most usage and users, which allows investors to dream very big on what the potential future could look like on those blockchains. Solana Bitcoin also looks quite solid here, clearing resistance levels one by one and getting very close to our previous range low. A reclaim of that level likely results in a big move. And we now have Solana and Ethereum getting very close to Bitcoin's 1 year performance. Ethereum almost flipped Bitcoin for 1 year performance last week. And I do expect Ethereum and Solana to end this cycle outperforming Bitcoin. And I do believe they are the lowest risk projects outside of Bitcoin with that potential upside. And it's great to see the global liquidity index slowly grinding higher here and getting very close to making new highs. It's all going to come down to the September FOMC meeting. If Powell is more dovish than anticipated, that probably sends the global liquidity index higher and the dollar index lower. If Powell surprises us with more hawkishness because of tomorrow's inflation data coming in hotter than expected, or the labor market being stronger than expected between now and the FOMC meeting, that could result in some downward pressure in the short term. So I'm going to be keeping a very close eye on that FOMC. We want to see global liquidity higher and we want to see the dollar index lower if we want risk assets to rally. And that's going to have a huge impact on what we see from these rate cut expectations. Right now, everybody agrees we're going to see a rate cut in September for the most part, but we're expecting a pause in October and another rate cut in December based on current data and based on current Fed commentary. We really want to see more rate cuts than this if we're going to get some type of extended cycle into 2026. But with the data as it stands, I do believe we're going to have a major correction in September because these are not enough rate cuts to keep the economy and markets going. But we'll see what happens. As I said, we are getting an update to the Fed's preferred measure of inflation, core PCE, tomorrow. We want to see it in line or below expectations. A hot print would spook markets and push back rate cut expectations because we know the labor market is weakening under the surface, but still looking quite resilient with headline data. We know the economy is weakening under the surface, but GDP is still positive, and we know markets are still doing fine. If you take a look at the S&P 500 making new all-time highs and Bitcoin making new all-time highs. So we really don't want stubborn inflation to ruin the party. But as we look forward, the federal government is still running huge deficits. That's a trend that seems to be worsening year after year, and exponential debt growth means exponential money supply growth when that debt eventually has to get monetized. And that's bullish for our risk assets like the S&P 500 until the bubble pops. And it's bullish for our fixed supply risk assets like Bitcoin. But as always, let me know what you expect. Thank you so much for the support on the recent videos. Thank you so much for watching, and I'll talk to you soon.